Do you have a high W-2 and want to utilize the short-term rental loophole, but you're worried that you might not be able to keep it as a short-term rental forever? Have no fear. We're going to go over a short-term rental loophole strategy in today's video. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise. We're empowering high W-2 and business owners with tax savings so they can grow with confidence and build their wealth faster. Today, we're going to go over what I'm calling the short-term rental loophole strategy, where investors can buy a short-term rental, convert it to a long-term rental in a year or so, but take advantage of all the tax benefits in the first year. So if you're a savvy business owner or you're a savvy high W-2 earner, short-term rentals are a great way to offset your W-2 income or business income with the depreciation they create when combined with a cost segregation. So the brief overview, the IRS does not treat short-term rentals as rental real estate under certain conditions. If your average stay is 7 days or fewer, your short-term rental is not considered a rental activity for all tax purposes. Instead, it's treated as a trade or business and therefore subject to different rules under Section 469. This matters because once your short-term rental is no longer classified as rental activity, you can use the material participation test instead of the REPS test to determine whether your losses are passive or non-passive. And of course, if they're not passive, then we can take all of those losses and use them against your W-2 income, which is where all the good savings come, where you can save tens of thousands of dollars per year. So there are 7 tests for the material participation test that we focus on 3 of them. One is the 500-hour test, right? You spend more than 500 hours working on the property. The 100 hours and more than anyone else test, and then substantially all work test. To qualify, you'll want to handle guest communication, turnover coordination, etc. Avoid hiring full-time, full-service property management, and keep a detailed log of all of your hours. So once you qualify your property as a short-term rental, what we can do now is accelerate the depreciation on it using the cost segregation. Normally, depreciation on these properties is 27 and a half years, but what we can do is push all that depreciation up into the earlier years, and of course that creates a lot of depreciation losses, which of course under short-term rental, we can convert from passive losses to active and offset your W-2 income. So an example, let's say you buy a $600,000 short-term rental, the land is $100,000, the building is $500,000. The cost segregation allows for $150,000 to bonus eligible items. You deduct those $150,000 in depreciation plus operating losses, and if you make $500,000 a year and you're at that 37% tax bracket, that $150,000 deduction can save you over $50,000 in taxes. So super, super powerful for you to use. Now, what happens in year 2? A lot of people that get into short-term rentals, they think that they need to hold it forever in order for them to take advantage of the tax savings. But as long as you don't sell, that basis and depreciation you just used is already utilized, meaning if we do the cost segregation, we push up all that depreciation, we take those losses and then offset your W-2 income. Well, now you already took those losses. So the following year, you're still on that depreciation schedule. And if you move it to a more long-term activity, meaning you have just long-term tenants, either renting by the month or the year or what have you, well, all that depreciation now becomes passive, but we already took all of it in the first year as active. So it's very, very powerful, and it allows you to only be short-term for a temporary period of time, and then you can go back to the kind of more passive long-term rental strategy. So if in year 1 you meet that 7-day average rental rule, you materially participate, and then you utilize all the losses in the first year, those losses are not passive. And they can't be clawed back in year 2 if you have to change your rental strategy. So there's a lot of legal support for that. The IRS passive loss rules explicitly allow exclusions for the 7 days or less under the short-term rental loophole and the use of material participation tests for non-rental activities. So there is substantiation for the short-term rental strategy. It's less clear on what's allowed and what's not after you utilize the short-term rental strategy, but we're pretty confident if you wait a year and then switch the rental activity, the IRS isn't going to say, well, hold on a minute, you switched back to being long-term, you got to claw some of this depreciation back. They're not going to get that granular, and if they audit you, you have a time log, and you kind of have all these things in place if you work with the right professionals. So that's what TaxWise is here to do. We help a lot of people execute these creative tax strategies and keep them out of audits, out of trouble, and maximize their tax savings. So if this sounds interesting to you, if this is new to you, please reach out to us. We'd love to help you execute a strategy like this. Our contact information is in the description below. Thanks so much for watching, and have a great day.